Trump says the war ends in 2 weeks. Iran threatens tech companies. Brent crude moved $11 in a single day. But here's what nobody is asking. If this escalates into a full economic collapse, and I'm not saying it will, but the probability is higher than it's been in decades, do you know which of your assets survives, and which ones go to zero overnight? I'm Roldán Ferrer, and I'm a finance expert with over 25 years of experience in global markets. I've lived through the dot-com bust, the 2008 meltdown, and every major crisis in between. And today, I'm going to show you the 5 assets that have survived economic collapse throughout history, and the ones that wiped out entire family fortunes in months. Stay with me, because this is the video I wish someone had made for me 20 years ago. Let's start with the hardest truth in finance. Most people think a collapse is something that happens to other countries, to Venezuela, to Zimbabwe, to Weimar Germany. They watch the documentaries, they shake their heads, and they go back to their stock portfolio thinking it can't happen here. But here's what 25 years in the markets has taught me. Every single collapse in history, every one, was preceded by a period where the majority of investors thought they were safe. The crack of '29 didn't announce itself. People were buying on margin, riding the wave, convinced the good times were permanent. Then, in a matter of weeks, the Dow lost 89% of its value. 89%. That's not a bad year. That's generational wealth. Gone. And the current geopolitical situation, the active war, the energy disruption, the sanctions, the threats against tech infrastructure, this is not background noise. This is the early tremor before the earthquake. I'm not here to scare you. I'm here to make sure you're not the person standing in line at a bank that isn't opening its doors tomorrow morning. So let's talk about what actually works. Asset number 1, gold. This is the oldest store of value in human history, and it's old for a reason.
During the crack of 1929, while the stock market was in free fall, gold held its value, and in real purchasing power terms, it actually appreciated. When FDR confiscated gold from American citizens in 1933, do you know what that tells you? It tells you gold was so valuable during the crisis that the government wanted it for itself. That's the ultimate endorsement. Fast forward to 2008, while Lehman Brothers was collapsing, while mortgage-backed securities were turning to dust, gold went from $800 to over $1,900 in the following years. And right now, with the current conflict driving energy prices and inflation fears, gold is sitting at historic highs. And if this situation escalates, the move isn't over, not even close. The one risk with gold? If governments declare a real peace and markets stabilize, gold will pull back. But as a collapse hedge, nothing in 5,000 years of human history has beaten it. Nothing. Asset number 2, silver. I know, everyone talks about gold, but silver is gold's underrated sibling, and in a real collapse scenario, it has one advantage gold doesn't: industrial demand. Silver is used in solar panels, in electronics, in medical equipment. So even in a world where financial demand collapses, industrial demand keeps a floor under the price. During the 1929 crash, silver dropped initially, but recovered faster than almost any other asset as industrial production restarted. And in hyperinflationary environments, like Weimar Germany or Zimbabwe, physical silver was used as actual currency when paper money became worthless. People were trading silver coins for food, for fuel, for medicine. The ratio right now between gold and silver is historically elevated, meaning silver is cheap relative to gold. If you can't afford gold, silver is the entry point into hard assets that every serious investor should know about. U.S. Treasury bonds. Now, I know what you're thinking. Bonds in a collapse? Hear me out, because this is where 25 years of experience matters. U.S. Treasuries are the safe haven of safe havens, but only in specific types of collapse.
In a deflationary collapse, like 1929, like 2008, when everyone is selling everything and running to cash, Treasuries are where institutional money goes. Yields drop, prices surge, and the people holding Treasuries made money while everything else burned. In 2008, long-term Treasury bonds returned over 25%, while the S&P 500 lost 37%. That's not a coincidence. That's the flight to safety trade in action. The caveat, and this is critical, Treasuries do not work in an inflationary collapse. In Weimar Germany, in Zimbabwe, in Venezuela, government bonds became worthless faster than the currency they were denominated in. So the question you need to ask yourself is, what kind of collapse are we heading into? If the current conflict triggers a global recession and deflation, Treasuries win. If it triggers hyperinflation through energy supply disruption, Treasuries lose. This is why you don't put everything in one basket, ever.
Asset number 4, Bitcoin and crypto. And I'm going to be very honest with you here, because most people in finance either hate crypto or worship it, and neither extreme is useful. Bitcoin was born in 2009, directly out of the ashes of the 2008 financial crisis. Satoshi Nakamoto literally embedded a newspaper headline about bank bailouts in the first Bitcoin block. It was designed as a response to systemic collapse. And in the decade and a half since, Bitcoin has survived exchange hacks, government bans, multiple 80% drawdowns, and a global pandemic, and it's still here. In countries experiencing real economic collapse right now, in Turkey, in Argentina, in Lebanon, Bitcoin adoption has exploded. Not because people are speculating, because people are trying to get their savings out of a currency that is destroying their purchasing power. That's real. That's happening. But here's what I also need to tell you. Bitcoin in a short, sharp crisis can crash alongside everything else. In March 2020, when COVID hit, Bitcoin dropped 50% in 48 hours before recovering. In a sudden liquidity crisis, people sell what they can, and Bitcoin is liquid. So crypto is a medium to long-term collapse hedge, not a short-term addict trade. If you're allocating, and I think a small allocation makes sense, think of it as the asymmetric bet in your portfolio. Small position, big potential upside. Accept the volatility. Asset number 5, and this one is going to surprise you. Productive land and real assets. Not REITs, not real estate investment trusts. Physical, productive land. Farmland, timberland, infrastructure. During the crack of 1929, urban real estate collapsed along with everything else. People couldn't pay mortgages, banks foreclosed, property values cratered in cities. But farmland in productive agricultural regions held its value because it produced something real: food. During the current conflict, we've already seen fertilizer prices spike, grain supply chains disrupted, and food inflation hit levels not seen in decades. The people who own the land that grows the food are not the ones suffering. They're the ones selling.
Now, I understand most people watching this don't have the capital to buy farmland directly. But there are agricultural ETFs, farmland REITs like Farmland Partners, and commodity funds that give you exposure to this asset class without needing to buy 500 acres in Iowa. The principle is the same. In any collapse, the assets tied to real physical production of essential goods are the last ones standing. Now let's talk about what went to zero, because this is the part that nobody wants to hear, but it's the most important part of this video. During the crack of 1929, stocks bought on margin went to zero. If you were leveraged, and most retail investors were, the margin calls wiped you out before the recovery ever came. During Weimar Germany's hyperinflation, savings accounts, government bonds, life insurance policies, pension funds, all went to zero in real terms. People who had worked their entire lives and saved diligently in the currency of their country lost everything. Not because they made bad investments, because they trusted the system. During the 2008 crisis, mortgage-backed securities, CDOs, structured products, financial instruments that major banks had given AAA ratings went to zero or near zero. Lehman Brothers stock went from $86 to zero in months. Bear Stearns, Washington Mutual, gone. And in the current conflict scenario, the assets most at risk are those with the highest geopolitical exposure and the least tangible backing. Overvalued tech stocks with no earnings, high-yield corporate bonds from energy-dependent companies, currencies of countries directly involved in the conflict, and any asset that depends on global supply chains remaining intact. I'm not saying sell everything tomorrow. I'm saying know what you own and know what happens to it if the situation gets worse before it gets better. So let me bring this home with the 3 things you need to do right now. 1. Audit your portfolio for collapse vulnerability. Go through every position and ask yourself, what happens to this if oil hits $150 and global trade slows by 30%? If you can't answer that question, you don't understand your own risk. 2. Build your hard asset allocation.
Gold and silver for the inflationary scenario. Treasuries for the deflationary scenario. A small Bitcoin position for the asymmetric upside. These 3 together give you coverage across the different types of collapse, because nobody knows which one is coming. 3. Think in terms of purchasing power, not nominal value. The biggest mistake investors made in every historical collapse was measuring their wealth in the currency that was collapsing. If your portfolio goes up 10